Welcome to the Broken Pie Chart Podcast, episode 345. I'm your host, Derek Moore. With me again is Mike Syder, Director of Trading at Zega Investments. Mike's, what's going on today?
Not too much. How are you?
I'm doing all right. Well, we are in government shutdown mode, which for the market so far has meant nothing, has it?
It hasn't, and it usually doesn't.
All right, let's go there right away since you brought it up. The usually doesn't. And we pulled some data. In fact, let's see who this is by. Oh, who put this out? Let me look. Let me go to it. And what they did was, and Mike, you were saying this is a partial shutdown. So it means some things are open, some things aren't, right? Is that the way you read it?
That's how I'm reading it.
Okay. So let's see. Ryan Dietrich went back and he looked at shutdowns. The last one was 12/21 to 125. So 12/21 of 18 to 125 of 19. It was 34 days. And the S&P 500 return was 10.3%. Okay. So he went back, though, and he went through all these. I think that's the longest one. And actually, that was the best the market did. There was one 22 days back in 95, 96. There's that symmetry to the 90s again, Mike, I keep talking about.
Right.
0%. There was one 2013. I remember that one. And I thought that was a full shutdown, but I could be wrong. There was a little easing of markets, but that was 16 days up 3.1%. So this went back to 76, all the shutdowns. The median is a return of 0.1% during a shutdown. And I would say the ones in the late 70s, in the mid to late 70s, most of those wound up being negative. The median return 12 months later is plus 12.3%. So I don't know, seems like the markets do really well 12 months after the end. There's only 1, 2, 3 down years, but the median's, 12.3%. So you should be loading up the truck in equities, right, Mike?
Yeah, I mean,
yes, we should load. No, we're not saying to do that.
No, not saying.
Yeah, no, go ahead.
Yeah, so I mean, long term, it's in no one's best interest, Democrat, Republican, whatever you are. It's in no one's best interest to keep the government shut down. So, it's an opportunity, I think, for both sides to try to get some political points and try to move the needle for their sides. But long term, the markets and I think the country have faith that, eventually a deal will be made. And so the market just, at least for now, is sort of shrugged off shutdowns.
It hasn't really mattered so far. It really hasn't. We haven't really seen it with yields much, I don't think. And yeah, you're right, though. It doesn't matter. Just looking at these, here's a funny one. Well, maybe because you need 60 votes in the Senate, but you see the ones in 77, 78, 80, those are Jimmy Carter was president, Democratic Senate, Democratic House. So you'd think, well, they have all three, just figure it out. But yeah, you need the 60 votes, I think, for some of this stuff. So maybe that's why they couldn't get anything done. Or they were just arguing with themselves. They couldn't figure it out. I don't know. I mean, look, Trump won first term. There was 3 shutdowns, and Senate and House were both Republican, according to this.
That's right. Yeah, that's interesting. There are times where it's a mix, Republican Senate, Democratic House, times where one party has all three. So no matter how much control there is, the government still shuts down on occasion. But at the end of the day, the markets don't matter or don't think it's an issue. And like if you pick most events in history and look at 12 months after, a lot of the time the market's going to do very well. And this is no exception.
The way I come down on this is it is short-term noise. You could see markets react in the short term, but that's right, in the long term. And by the way, that's why we hedge. So we're kind of joking, back up the truck, but it is interesting, just the data, according to what Ryan Dietrich's pulled here. that markets typically are higher. So I think the timing on this matters too, of when they happen. So I'd forgotten in 95 they did that. There was actually two of them. So it was one in 95 and there's another one at the end of 95 into 96. So that gets into those continuing resolutions. So all right, we'll see what happens there, but so far okay. The other thing is markets made another all-time high, and we're starting to see some talk about bubbles. Is this a bubble? And somebody posted on Twitter, there was a chart that said approximate lifespan of historical bubbles. This is from Deutsche Bank Research. And they cite, the roaring 20s that was 5 years. The .com was 5 years. Japan asset bubble, 86 to 89, that was 3. Mississippi bubble in 1717 to 1720. I know you were pretty short the market at that point, Mike, in 1717. So
That's a little early. Yeah.
yeah, a little bit before our time. Tulip mania, 3 years. UK railway mania was 2 years, and South Sea bubble in 1720. Remember what my portfolio looked like back then, but that was a little less than a year. So people are starting to say this is a bubble. I don't know. I mean, what do you think?
I mean, like we say, we'll know when we know, but certainly there's real growth and revenue behind these companies that are growing. Um, these heavy weighted tech companies that are developing new capabilities with better margins, increasing profits. I mean, you're not early, but I and PE, sure, they're a little higher than usual, but I don't think that these companies can't grow into that number.
The difference right now is the margins. So margins in the S&P 500 based upon the forward 12-month estimate is basically 14%. And you do that, you take the forward 12-month estimate, Bloomberg has it at 284.19 per share. So a per share number on the S&P 500, and you divide that into the sales per share, which is 2020 spot 58, and basically it's right around 14%. And when we think about where returns come from, like you could, let's say over the next year, those numbers came in exactly as you thought, but margins went from 14 to 28%. Like the market would get cheaper because earnings per share would go up because you're making now 28% off that 2020 instead of just 14%. So margins are a big deal. And I think a lot of people thought they would come back down. That hasn't happened. Sales growth, I mean, long term, I think 3% annualized sales growth is pretty normal. I mean, they have it about 4.4, 4.5%. And earnings per share is projected to grow at 8.62%. So, yeah, I mean, we're 23 forward PE. Like you said, you're not low, but to me, I mean, these are in the early 2000s. Just if you look at the top 10 companies, I've said this time and time again, Sirius Satellite Radio was the number one weighted company in the NASDAQ 100. Today, it's what, NVIDIA, right, Mike? I mean, it's
Right.
so, I mean, how many radios were they going to sell in cars? It's like, and they didn't have real earnings. They really didn't. And that was your number one weighted company. So I just don't think you can make the correlation between today and 2000. Is it a bubble? Like you said, well, no, we don't. All right. I mean, let's
Yeah,
see.
I think a major question is how much more profitable can these companies get without necessarily increasing sales, right? Like how high can that margin go? I think that that we're still AI's been around for a little bit, but I think it's still there's still the potential where AI is going to create more profits for companies because of margin.
I didn't put it in our our show notes for today, but on Twitter I should have done it. On Twitter there was this thing going around. I forget who the gentleman was who posted it, and he's basically saying things like the CAPE ratio are faulty, and the reason why it's faulty is because it doesn't account for share buybacks. So for anyone who doesn't know what the CAPE ratio is, you basically take the 10 years of trailing earnings per share in the market. You can do it on a stock too. You divide the price by the average of the last 10 years earnings. And that's your CAPE ratio. And it's high right now. And I've always said, I mean, look, the CAPE ratio is, I think it's an interesting academic exercise, but it's using trailing earnings. And it also, it can, if you sold every time it went above the median or the average, you would have missed out on a lot of the market. The point that this person made was, like, if you look at a company who's doing a lot of buybacks and their trailing earnings per share are based upon that year's share count. But what if they bought back half their stock in the next 10 years? Well, you really should readjust the earnings per share on the new share count. So you get what I'm saying there. Right now, it's just added up all the EPS, but that year 10, 9, 8, 7, 6, 5, it's all based upon what the share count was then.
Right.
So I don't know. I don't know if you have any thoughts on CAPE, but I thought that was an interesting way to do it. And because reducing the share count definitely helps the EPS.
Yeah, for sure. I think that that's something that needs to be factored in.
Do you like CAPE or no?
I don't follow it too closely, to be honest.
I mean, to me, it's the forward estimate that's better.
Right.
Someone should do this. I don't know. Maybe I'll do it, but somebody should do this where they redo the CAPE ratio, but instead of the trailing earnings, they look at what the forward earnings were at every point.
That'd be interesting.
It would be, yeah. Like you could kind of say, what was the trailing, then what was the forward? Because forward is what matters. I mean, on a trailing basis right now, we're about 25.8 trailing PE. We're lower on a forward 12-month basis. We're about 23.7. So, yeah, I don't know. The other thing, too, I think we look at with where the markets are, I mean, just thinking about year to date, S&P is up annualized 21%, but it's up 15.47% year to date. The US AGG, the aggregate bond index, plus 6.5. Gold is up 44.56. Small caps trailing at 11.21. The Qs up 19.16. And what is that? EFA, the EFA, the not emerging markets, developed foreign international is up 27.3. So, like, would it be crazy if we went up another 5 points and got to 20% for the year? If we got to 23, I don't think so. Do you, Mike? I mean, normally we get a lot of those in up years.
Yeah. The last 3 up years have all been 20+%. The most recent up year that wasn't was 2020. It was up 18%. So no, it wouldn't be out of the question for the market to be up 20+%. I mean, I think this next round of earnings coming up are going to be crucial. Seeing if these earnings come in and are hitting the expectations. The expectations have gotten up there, like we've said, but the companies continue to hit them. So if that happens, I could certainly see this being a 20+% year.
So when we look at the decade to date, and I like to look at this stuff. So I ran the numbers from January 2nd, which was January 1st. There was no trading. January 2nd. So through October 2nd, I guess I could have done today. I don't know why I didn't do it today, but it's not too much difference. The annualized return decade to date is 15.07. So, I mean, it's not too crazy. Now, do you wind up doing another 15% from here to the end of 20 29. I don't know, but I mean, it's not stratospheric, right?
Right. Yeah. It's not anything that would, I don't think, make me pause and say this is gotten out of hand by any means. I think the numbers are there to justify it.
I'm trying to pull up on the fly. I used to have this chart handy that we made at the end of 2019. Yeah, I found it actually. So returns by decade. Here, let me send this to you. I'm kind of doing this live. But, where would this, if the decade ended right now, where would we sit? And the answer is it definitely wouldn't be the highest. Now, granted, we're only almost through the first full 6 years, right? So we have 26, 27, 28. Yeah, so 4 more years left in the decade. But if you look at this, Mike, I mean, 18.3% was the total return in the 90s. 1980, 7.68. The 2010s was 13.33, minus 0.99%. These are all annualized returns in the 2000s. You have the 70s and the 60s, plus 5.8, plus 7.78, 19.61 in the 1950s. And that's actually the largest decade return going back to the 1900s. And so, I mean, that wasn't the largest return until it was. So, this is why we hedge though, because sometimes markets are up. And I know you start to get this forward return stuff and you look at, oh, if the market's up this much. The reason why we hedge is because you want to take the timing out of it. Somebody putting new money to work, you say, well, I will be hedged, and so I have some material downside protection. And that way I don't have to try and time the market. But yeah, I don't know. I should run the numbers to see towards the end of the deck if we wanted to average 20% annualized, like how much more annualized return would we get from here to the end of the decade? I guess I could do that, but look pretty normal for markets.
Agreed. It seems like it would be right in line. I mean, it's been a great few years, but it doesn't seem like it's anything that is unprecedented.
I am curious though. So, what if we go back 10 years from here, which is totally random because it'd be October 3rd through October 3rd, so 10 years ago was what, 2005? So if I go to 2005 and I look at the annualized return since October, here I'll do October 3rd. Yep. So I'll do that. And the annualized return over the last 10 years, 10.99. So no, that's 20 years.
Yeah. Okay.
All right. So there you go. I already looked it up, Mike. So we don't have to look that one up.
Okay.
2015. I should have done this ahead of time. So 2015, okay, 15.13 is kind of the annualized average going back, and that would be lower than the 90s, the 80s, the 50s, the 20s. It would be lower than those periods if we just kind of carve that in. So, all right. My point is that this stuff is really hard, and everyone's talking about a bubble right now. I'm not sure if it's a bubble. And if you listen to somebody like Dan Ives, who is an analyst, and I saw him talk at the Future Proof Festival, like he believes we're not towards the end of this run with AI and some of the CapEx spending and the efficiencies that are going to come in. So if we get more productivity, to your point earlier, maybe margins actually expand more. We'll see.
And, calling a bubble, it's just so difficult to do. Like, what do? You go to cash, and then you wait. The market keeps going up, and then eventually the market's going to go down. But like, how much money did you miss out on when the market went up by sitting in cash? So I think, like you said, that's why we hedge. You stay long and you hedge, though. Maybe the market will sell off and there's a bubble, but odds are that if you do something drastic and you're in cash, you're probably going to miss out on gains rather than be able to time this thing perfectly and get back in after the market's sold off.
The thing too is the catalyst that would cause significant market changes. I don't think anybody really knows. Like
Right.
if you look at this would be interesting to see what is everybody worried about. And normally the thing that causes the problem wasn't even on the list, right?
Right. There's the things we know that we're concerned about, things like inflation and, employment levels and, um, interest rates. And then there's the unknowns that we don't know about. And those are typically what come out of nowhere and cause the market to sell off.
All right, let's look at this is from Ryan Dietrich as well on Twitter. Titled "More Clues: Q4 Could Be Strong." S&P 500 returns after the top 15 September returns ever, 1950 to current. So, what he did was he ranked the top month of September returns in the S&P 500, and 2025 was the 14th best ever. The best was 2010. And aside from two instances, so 13 of the 15 were positive. The median was an October return of 0.6% positive and Q4 return of 5.4%. If we got that, we'd be up over 20% for the year, Mike.
Right. Yeah. I mean, it's sort of maybe a momentum indicator heading into the end of the year where September sort of kicks it off, and positive Septembers lead to strong Q4s and generally strong Octobers too. Um, we'll see what happens this time. But like you said, there's only been two other instances where Q4 was negative when, if you were in the one of the top 15 September returns ever.
You've been in markets for what, 20 years now? Is that right?
15.
15, okay. Do you ever wonder, and maybe because I'm a little older, I go back, to 94. I mean, I wasn't in markets in 87, but I certainly remember that. When people talk about years that you remember, but they're talking about it historically, what I found, and let me know, what your experience is with this. Like people just see the numbers, but they don't understand like what people were feeling and what they were saying, what everyone else around them was saying. And I keep going back to the 90s. And I will tell you that in 94, we had the interest rate hikes, the cuts in 95. We had more cuts I think in 96, very similar to right now. But everyone in I remember 95, 96, as the market was going higher, the memory of 1987 crash was still in people's minds. And I can't tell you how many people said, oh, this is too much too soon. It can't go up. We're setting up for another crash. Might be worse than 87. And there were people with money on the sidelines and just sitting in money markets. Now, was that the right thing to do or the wrong thing? It depends what their goals are and what they're trying to do and their timing and all that. But have you found that, you were in the markets in 08, 09, right?
I was involved in the markets. I was still in school then, but very much paying attention and, worked on the floor during those periods for
Yeah.
a little bit.
But I mean, when you go back to those periods, are you when you hear people just talking about the data versus what everyone was thinking, do you ever think about that? Just kind of the experience of, I don't know, maybe I'm looking at it wrong.
Yeah, no, for me, it's more, I would say 2010 to 2015, right when I really got started in this industry. Almost, so many people were fearful of getting into the market and saying there's no way that we've recovered from 2008. Um, I'm afraid to put my money to work because another 2008 is going to happen. The system's broken. So those are years that I remember very clearly of people still being on the sidelines from 2008 and being very worried about getting back in. And you look at the numbers and they don't really tell you that story.
there were periods too. I remember the 2000s where these stocks just kept going up and up. And I remember looking at some of them saying, if their sales increase, actually it's going to cost them more money with more sales. Like normally, the more sales you get economies of scale. Like there were uneconomies of scale.
Mm.
And in the opposite side, I was like, this just doesn't make any sense. And they're going up 10% a day, 20% a day. And it was just, and there were also companies. I mean, Amazon got absolutely killed. You could have bought Amazon for a song in, I don't remember what year, 02, 03, 01, 02, one of those periods, 2000. I don't know. It's just an observation. Like everyone has an opinion on markets, but it would be fascinating if you could go back, and CNBC has only been around since what? Probably either late 80s or early 90s. But imagine if you can go back and just watch a CNBC broadcast and all the people coming on and saying what they think the market's going to do. And probably none of it would happen.
Mm-hmm. Yeah, like a montage of
Mm-hmm.
what people said throughout a year, and then comparing that to what the actual returns were.
Do you remember that show? Was it Louis Roykaiser, Wall Street Week? It was on PBS. It was on once a week. And they used to bring in different market experts and people like that. And, they would give their predictions. And in hindsight, imagine listening to those and seeing how wrong everybody was. Like nobody knows anything. That's the thing.
Right.
Just, I mean, trying to time this is tough. All right, let's get back to the, so there was a chart. I forget who this is from. It says job openings, total non-farm payrolls, Bureau of Labor Statistics. Somebody did a chart. T7. Actually, I don't know whose logo this is. So it was total job openings and the S&P 500, and they were moving up. They were pretty much in lockstep, and they've got this vertical line indicating. So it's Thursday, December 1st, 2022, and that's when ChatGPT was released. What you find is the S&P 500 has continued to go up, but job openings have come down. I just like, I mean, I don't know if this is totally causation here, but it's kind of an interesting chart. Like, is ChatGPT really causing companies not to have to hire?
Yeah, I mean, like you said, it may just be somewhat of a coincidence, but when you look at this chart, it goes back to what, 2003.
Mm-hmm.
The job openings pretty closely follows the S&P 500. You see the dips there in
Yeah.
2020 during the COVID sell off, and then it immediately recover from there. Um, and when you think about it, AI is there to, like we talked about earlier, boost profits and margins, and that's because you need less of a workforce. So I don't know if it is. Obviously, we can't say for sure that this is exactly why this is happening, but certainly would make sense that AI and ChatGPT are reducing the number of openings and jobs needed.
I mean, think about too, if let's say you were a Wall Street analyst and you're a Wall Street analyst in the 90s, you probably, the main analyst covering the big stocks, you probably need people to be doing research. And I just wonder, I mean, maybe that's where some of this is the productivity gains. Like somebody could just, if Bloomberg ever integrates AI completely, you could say to Bloomberg, show me, build this chart for me. Here's what I want to do. Just go ahead and build it. And it just gets built. But I don't know. This is something to watch though. And I think if you were going to explain this, you would say that because companies are getting productivity gains, this is why the market's up and job openings are down. Like it's not a factory. You don't have to hire more people to produce more widgets.
Right. There's no
Tech,
actual product being made.
no,
It's
I mean, and tech companies are very efficient now. You don't need to. So, all right, monthly rent So what are we saying here? This is from Charlie Bolello. So monthly rent, national median, year over year change. I think the point he was trying to make with this chart is since it looks like July of 23, since then, the year over year has been going down, meaning rent is getting cheaper. It's not getting more expensive. We're not seeing that. We're seeing it come down. I mean, it did go up 18.2% year over year in, what is that, January of 22. So maybe it's just slowly coming down from then as people's leases come up, but seems to be like good news for renters. But since we had that spike, Mike, I wonder if that's just kind of releasing steam there.
Yeah, I think it's a little bit of a slow correction from that spike there. Um, People prove that they're willing to pay those high levels. So I don't see landlords saying, "Well, because it went up so much, I'm just going to drop it back down to previous levels." Right? There are people that were willing to pay it, so I wouldn't expect them to continue to climb at that level that they were, back in 2021 and 2022. But I also don't see a reason why it would, fall off a cliff just to, just to reverse those previous increases.
Do you think too that a lot of the building owners or apartment complex owners, they already financed at lower rates? Like you would think that if rates are higher, their capital costs are higher, so they have to charge higher rents. But maybe these aren't newly financed buildings, or they financed with cash. I don't know. I mean, I guess you can just charge what you can charge. You need demand to meet those, but it seems like it's good news for inflation, I would say.
Yeah. Yeah. I mean, we looked at a chart a couple podcasts ago, I believe, where it showed, the average interest rate that homeowners had. And, it could be, like you said, something similar here with landlords where they're locked in at much lower rates than what you would get today.
All right, let's talk about the bond market. And we look at yields right now, and obviously let me just pull up the treasury rates. Yeah, so like if you look at treasuries right now, this was the other worry that everybody had. They said, yields are going to spike. I mean, they've come up a little bit, but 4.12% in the 10 year. The 20 year is 4.68, 4.71 on the 30 year. Like if you actually wanted to add duration, to me the 20 year seems like a better risk return versus having to be tied up for an extra 10 years if you wanted to add duration. But I don't know. I mean, the Fed lowered rates, interest rates have been coming down on the 10 year, but there's nothing I would say interesting or crazy happening right now, is there?
No. As far as this drawdown that we've had, yeah,
No, just in general, just treasury rates in general. I mean, we have a 4.1 10 year. It's neither very interesting or very. It is what it is. I
it
don't
just
really
seems
have
like
anything to
I
say
don't
on it.
know. Yeah, I agree. It just sort of seems like it is where I don't want to say it should be, but it feels right for this environment.
I mean, the 2 year is 4.042, and a lot of times the 2 year is kind of a proxy on what the Fed funds rate will wind up being. So, I mean, the Fed funds rate right now is, after they cut, I mean, the effective Fed funds rate is 4.09. So, I mean, we'll see if they cut more. But by the way, you would think the Fed funds rate should be lower than the 2 year, because the 2 year, you're giving somebody your money for 2 years. Fed
Right.
funds rate is right now, I'm going to loan a bank or somebody money overnight. So I don't know. But yeah, I think what you were referring to is the drawdown. So Charlie Bolella tweeted something out. Bloomberg U.S. Aggregate Bond Index, the longest drawdowns since 1976. We are still not out of a cyclical bear market in the U.S. aggregate bond index. The AGG is a good example on the ETF on a total return basis. So the max drawdown was minus 17.2%. That was the largest going back to 76. It's been 62 months. Meaning if you had bought, let's say, the AGG on the beginning of September, in September 20, or you top ticked it, August 7th, I think, of 2020, you're still down. Your annualized return is something like negative 0.5%. So yeah, I mean, think about that. If you bought in 2020, before the downturn, you are not break even again.
Yeah, I mean, I think you have to look at not just the last 62 months since that top, but also what led to that top. Right, we were in sort of two unprecedented periods for interest rates in the bond market. You have one period where you have rates near zero, right, and then another period where rates quickly climbed from zero to over 5%. 5% historically may not you know be a huge number, but to go from 0 to 5 is a significant difference. So you put those two things together, it's sort of a perfect storm.
Just out of curiosity, I typed in from August 7th of 2020, the 30-year total return treasury index. So this is kind of like a rolling, you always have a 30 years to maturity, and the duration changes based upon the interest rate, what your sensitivity to interest rates is. But that is still down on a total return basis, 43.5%. The annualized return is negative, almost negative 10.5. So, I mean, they're not getting back to break even anytime soon. Like they would almost have to hold that bond up through, I don't know, almost to maturity probably. I'd have
Right.
to do the math on it. I am curious though. So let me see how far. I can't go back to the 70s. It only goes back to 89. What I wanted to see was if you bought the 30-year treasury, the total return from like 75 through 82, to see what the change would be, how much worse it would be, or if it was. Because to your point, the starting yield was near zero. I mean, 30 years, it wasn't near zero. It was probably 75 basis points at one point. But yeah, I mean, that's why the losses are so magnified, because you're starting from a low level. But interest rates go up, bonds go down. So yeah, I don't know. I mean, they're better to put in a portfolio now. And look, we use bonds as part of a funding source to synthetically own the markets and hedge and do a lot of and buffer and do a lot of stuff. But it's rough. If you had duration coming into this, it's going to be a while, right?
Yeah.
All right. Let's see. What do we miss on our doc here? Let me go to our supplementary doc as well.
The top 10 companies by decade.
Oh yeah. So let's get into this a little bit. JP Morgan, their guide to the markets, they put a slide in, and I thought it was really interesting. So it's top 10 companies by decade, as you alluded to. And what they did was they showed what the top 10 were in 85, 95, 05, 15, and 25. And then they color coded them so you could see, like, Microsoft is in the current mix. They were in the mix in 2015. They were in the mix in 05. But they're the only one who is still in the mix from 05, which is pretty impressive. So you look at the companies in 25, 1, 2, 3, 4, 5, 6 of them, NVIDIA, Amazon, Alphabet, Meta, Tesla, and Broadcom, were not among the top 10 in 2015. Those included Procter & Gamble, Chevron, GE, Wells Fargo, who else? J&J, Exxon was in there. And then Apple. Yeah, Apple's still in it today. So I think the point of bringing this up, Mike, was just this is why you own the index, and it's another visual representation of that. Although I will tell you, it was impressive that Exxon was in there in 85, 95, '05, and 15. And GE, I think the same. Yeah, GE actually made it all the way to 15 as well. So that's a 40-year span. I believe they were in there prior to that. So I don't
They're
know. I
the
mean,
exception, right? I mean, that's two companies. It's just tough to it's tough to pick if you're going to hold individual stocks long term and you're just going to hold a few of them. It's tough to know which are going to be the ones. Even though today it seems like where's Apple going to go? They can never go away. And I think the same thing. I use Apple products all day long, but these charts show you that eventually these companies, their time comes, and doesn't necessarily mean they go to zero, but other companies come in and replace them. So whether it's actual loss of capital or opportunity cost because you don't own the index and exposure to other areas, that it's tough to do that long term.
I think it's also one of those things is you might think you know who's going to be one of the top companies, but you really don't know. You really don't know. I mean, I don't think anybody had any idea that Nvidia was going to grow like this. I'm
Right.
sure there are some people. Well, actually, Mike, I should say we see some people who did, or at least bought the stock. I don't know if they were visionaries and really saw this because we manage some of the, we hedge. People have concentrated large positions. Sometimes we hedge it, we generate income on it. Like we see some of this. We see the cost basis is very, very low, but you have no idea. And you think about in 2035, there will be companies in the top 10 that really aren't on the radar right now. So that's kind of interesting. Does it surprise you that this many companies stayed in the index for this long, or does it surprise you that we've had this much turnover?
It does not surprise me that we've had this much turnover.
Yeah.
I mean, I've been involved in managing concentrated positions for some time now, and it's whether you want to hedge it or just manage the risk around it. It's you know you have to think about what happens if something happens to this company specifically. So I've been looking at charts like this for a while. Very well aware that generally the top weighted companies don't stay the top weighted companies forever. So it doesn't surprise me to see this.
I'm looking at J&J. I just randomly pull them and I'm looking at them. So the market cap is it 454 billion? I'm trying to see if this is in millions. Let me look at Nvidia. See what it is. Yeah, so that's they're 4.5 trillion. Let me go back to J&J for a second. And I didn't even know what J&J, what their market cap was before I looked them up, but let's see. So it says 454,309.0 million. So is that 454 billion? I think that's the way it is, right?
Yeah, I believe so.
So the reason why I randomly pulled this up, let me just see. J&J market cap. Yeah, 454 billion. So 454 billion, the market cap in 85 of all those top 10 companies was 251 billion. In 95 was 597 billion. Like I get it. J&J isn't one of the top 10 companies anymore. But if you look at a price chart, I think they just made another all-time high. Like they didn't go to zero. It's just other companies came in and they overtook them. If we look at Exxon might be, now I'm curious on Exxon. So that's XOM. Their market cap is 482 billion. Pretty high. But
Yeah,
they're not in the top 10 anymore. They were in there 10 years ago. So it's not like these companies have gone away. It's just other companies, and that's the beauty of an index. You have these pieces, right?
right. Right. That's where the opportunity cost comes in of just owning one company. It's not like, yeah, it's like you said, it's not like these companies go away. They just, there's other companies that come in and perform better.
AIG, they were in 05. And of course, they went through the great financial crisis, the GFC, 44 billion. I don't know what they were back then, but it's not quite as much. Okay. I'm probably the only person who cares about this stuff. I know you care a little bit about it. And it is additions and subtractions in the S&P 500. September 22nd. So we were talking about this. Remember we said EA Financial
Right.
went private, and I think I don't know if have they put somebody in their place yet.
Last I looked, they hadn't.
Let's see. I'm looking right now. So Market Access Holdings, MKTX, they were removed in September. Caesars Entertainment and Enphase Energy were all removed. Of course, Interactive Brokers was put in August. So AppLovin, RobinHood Markets, and MCore Group, apparently that's an industrial company, they've been added to the S&P 500. So there you go. There's that turnover too. And so let me see, like CZR. So, one of these days, Mike, we'll actually plan all this ahead of time. But CZR, if I look at their financials, I wonder what their total revenue was and their let me see here. If I go to the income statement, like there's 3 people still listening now waiting for me to do the income statement here. Yeah, so it looks like their sales, so Caesars was about 11.3 billion and their operating income was about let's see. Their income available common. Oh, they had negative gap. Okay, so they had negative income. So let's pick one of the new ones. So let's go to. Do you think Robinhood has their earnings? Probably, right?
Probably.
If I go to their financials, the point I'm making, folks, by looking this up, is I'm sort of making the point that when companies leave and then companies come back in, sometimes the companies that come back in are growing. There's a reason why a company got taken out. So less in revenue, let's see, 3.5, and then net available to common base. Yeah, I mean, they have positive earnings, it looks like. Net income 1.7 billion last 12 months. So there you go. We just did that on the fly. Yeah, I mean, I think that's a big deal, and I think it's one of the reasons there's some percentage of the EPS growth that comes from these rotations in the membership of the index. Somebody should do an analysis on that.
That would be interesting.
AppLovin, do they have earnings? All right, I'm not gonna keep looking it up, but I don't believe that there's been a company replace EA yet.
I don't think so.
So that will be the next one.
Yeah.
All right, Mike. Any recommendations this week?
So I took your recommendation from last week, and I'll second it. Black Rabbit. I liked it. Well, I haven't finished it, but I like it so far. If you've seen Bloodline, which is, I don't know, like 10 years old now on Netflix, it's sort of like that. I think it's pretty good. So going to try to finish that. And then playoff baseball. There's nothing better than playoff baseball. Even if you think the game's slow, you're not a fan of it during the regular season, every single pitch is amplified in playoff baseball, and it's tense, and I love it. So,
and Cubs are moving on, right?
we're moving on. Yes.
All right. Apologies to all
close
the
there for a
Padres
second,
fans.
but yeah.
So I would agree. Like playoff baseball is great. I watched the Yankees play the Red Sox last night, and the rookie pitcher, 12 strikeouts, 8 innings, no runs, was like
It was
lights out
great.
last night. Yeah, he was tremendous. So as much as I sort of don't like the way the team is constructed, I'm still sore about losing to the Dodgers last year. I thought they didn't play well, a lot of mistakes. It was great. So I would agree there. And you remember I gave a pre-recommendation on Black Rabbit. I watched the whole thing, Mike. I think it's really good.
Okay.
I really like it. And we don't want to give away anything, so it's a strong buy recommendation for me. It's on my conviction list. So I it reminded me a little bit of Ozark, and I think it was the same showrunners or maybe the same producers that did the show Ozark. And by the way, Jason Bateman was in Ozark, which is pretty good if you haven't seen that. Yeah, I liked it. But Jude Law with an American accent and kind of a New Yorkish accent was interesting.
Yeah. Yeah, he's good. It is a lot like Ozark. That's a good call.
So yeah, strong recommend. 8 episodes, Netflix. Definitely watch that. I also watched I think the first episode of Chad Powers. Do you remember when Eli Manning went undercover at like a Penn State open tryout for quarterbacks?
Yes.
So they made a show out of it. It's the guy from Twisters. Powell, I think his name is, the actor, and he was kind of the hothead in Maverick, Top Gun Maverick. I think you
Okay.
know what I'm talking. Glenn
Yep.
Powell, yeah,
Yep.
Glenn Powell. It's on Hulu. I think it's a buy recommendation. It's not a strong buy conviction list, but it's not bad. So
Okay.
there you go. So all right, well, who are the Cubs playing next?
The Brewers.
Okay,
It's going to be tough.
baseball is interesting though because I feel like last couple years the teams that have the advantage don't have the advantage because baseball is about rhythm and timing, and the Brewers have been sitting around since. I mean, they will have been off 5 days, right? By the time you play.
Yes, but the Cubs celebrated like they won the World Series last night, so we just got to hope there's no hangover.
Yeah, literally and figuratively. All right. We'll end it there. Good luck to the Cubs and Yankees and whoever your teams are. And if you are a Miami Marlins team, better luck next year. Okay. That's it, Mike. We did it. And we'll talk to everyone next week. See you, everyone.